Federal Reserve just increased the federal funds rate from 1.75% to 2.5%. And my name is Freddie Finance. I'm a licensed financial advisor, and I'm going to go over what the Fed rate hike means for you and how it's going to affect the U.S. economy. So the Fed raised rates to cool down the economy. Many other reasons are behind this, but the surging cost of living has really taken a toll on consumers, and the rising rates are going to come with their own set of opportunities and obstacles. So before we dive in, let's go over the definition of the federal funds rate. It's basically the interest rate that is charged to commercial banks for lending money with each other. It is the most important interest rate measurement to gauge what is going on in the U.S. economy. When federal funds rates are low, borrowing is high. When federal fund rates are higher, borrowing is lower because the cost of borrowing varies based on this interest rate. In 2022, the Fed has raised these federal fund rates by 1.5%. This might not seem like much, but this is the most they've raised it in 3 decades. It just goes to show that many things are happening in the economy and adjustments are being made. And central bankers have been saying that more rate hikes are going to be coming, so it's so important to understand why they're hiking them, what it's going to affect, and how you should handle yourself. First thing that the federal funds rate hike is going to affect is the prime rates that immediately affect the financing costs that consumers and businesses take. They are now going to incur more costs for borrowing money. But on the bright side, higher interest rates are good for savers because that means they're earning more money in their savings accounts than before. With the Federal Reserve rising interest rates at an unprecedented pace, it's important to understand that variable debts such as credit card debt or home equity lines of credit are going to be the ones affected the most. Since most credit cards' interest apply to a variable rate, there's going to be a direct connection with the Fed's benchmark, which is the Fed funds rate, and how these interest rates change. So when the federal funds rate goes up, the prime rate goes up, and then credit card rates follow suit. Credit card interest rates are hovering around 17% right now, and a lot of expert analysts are saying that it will jump to 19% with this federal funds rate hike, which would be an all-time high. That means if you hold any outstanding balances on your credit card, aka you haven't paid off your statement balance on time, well, be ready to shell out more money because the interest rate is going to go up. Application tip for you. As rates rise, the best thing to do is to pay down any debt you can and start with the largest interest-bearing debt you have. 2 more pro tips here. If you're already carrying an outstanding balance on your credit card, try calling the credit card issuer and asking for a lower rate. In times like this, they tend to show some leeway for people in tough times. Or if you're a homeowner with an outstanding credit card balance, you can use a home equity line of credit to pay down the credit card interest and then switch to an interest-free balance transfer credit card. Moving along here, the federal funds rate hike will have a direct effect on adjustable rate mortgages, home equity lines of credit, and even auto loans. As you can see, this rate hike is a crazy butterfly effect that affects every single person in the economy. And if you're learning one thing throughout this video so far, please hit the subscribe button, please hit the like button, and keep on watching. And how could we forget about good old student loans? So student loans tend to have fixed rate loan terms, but this will not necessarily affect current student loan debt bearers, but this can affect future student loanees. And it's important to know that the federal student loan rate increased to 4.99% from 3.73% a year ago. Based off everything macroeconomically that's going on, I can almost guarantee you that the student loan rate will increase. As I mentioned earlier in the video, savers are probably the only people that are going to benefit from this rate hike, but this is usually a short-term ordeal, so it's not great to save money for the long term. As always, it's never good to save a lot of money. So what is coming next for interest rates? Well, it is very safe to say that based on the macro state of the U.S. economy, the Fed is going to continue to hike interest rates. Remember, the Federal Reserve printed the most money they have ever printed in 2020, and effects from that do not happen immediately, but it's 2 years later and we are now entering a recession and seeing the effects unfold. So putting my financial advisor hat on right now, it is important to not make any drastic changes to your portfolio right now because there is still much more uncertainty that lies ahead. If you were my client and you didn't need any of your money that's invested, I would literally tell you to sit back, do nothing, watch, and buy more if you can. And the best thing that you can do for yourself right now is tighten up your spending. Go back to your budget, see what you're spending money on, look at some cash surpluses or cash outflows, and try to maximize more money coming into your bank so you can then invest it. If you don't already have a budget, you can check the link in my description, download the exact one that I use for free, and start keeping track of your cash flow. I hope you guys learned a few things about the federal funds rate hike and how it affects everybody in the economy. Drop a comment. Let me know what you think. Let me know if you have any questions. My name is Freddie Finance, and I'll catch you guys next time.